Explain three ways through which individual could engage in tax avoidance. 3B, explain three ways an individual we say could engage in tax avoidance. An individual could engage in what we call tax avoidance. The first part of the question is basically to understand what the question basically asks. So the first thing is to understand they need three modalities in which an individual can engage in tax avoidance. Number one, what is tax avoidance? We say that tax avoidance is what we call a legal means through which a taxpayer can minimize the tax burden. And so this calls on a very good tax person, that you can look at the tax system and identify some of the loopholes that are basically there in the tax system and take advantage of them in order to minimize the tax burden. If it's noticed, for example, that you are avoiding taxes, that you are engaging in tax avoidance, we know that for sure that penalties and interest will not be constituted because tax avoidance is basically legal. But of essence is that when the Kenya Revenue Authority maybe identify that the loopholes are very huge, they can decide to seal those loopholes. But you say that the taxpayer will not be instituted for what you call penalties and interest when it's noticed that is avoiding taxes. Number one, we can talk about the area of allowable deduction. For example, if you're contributing to pension, if you're contributing to a registered pension scheme, we say that it's allowed to a set limit of 240. That is, you're going to compare the actual amount with a set limit of 240, and you also compare with the third thing, that is 30% of the gross employment income. And the law of the three, you can use it to lessen your tax burden. So number one is what we call allowable deduction. We call it allowable deductions. Allowable deduction, i.e. pension, i.e. contribution to pension schemes. We say it is allowable to a set limit of 240,000 per annum. And that is to say, you compare the actual amount, 30% of the gross employment, and the set limit. We say that the set limit of 240 per annum. So you compare those three, you pick the lower. Still on the allowable deduction, we say mortgage interest. Mortgage interest. If the interest that basically accrue from a mortgage that you take from a reputable organization like the bank, we know that it's allowable. We say allowable to a set limit, of 300,000 per annum. So you can have it, just to expand it deeper, we say actual amount, you'll have the actual amount, the figure there, and then you compare with the set limit. We have the set limit, which is 300,000 per annum. So you pick the lower. So that is the first area that an individual could basically engage in what we call tax avoidance. The second way an individual could engage investing in areas where withholding tax is a final tax. Investing We can talk about investing in areas investing in areas where we call it where withholding tax is final tax. So what are these areas? I.e., we call it qualifying dividends and qualifying, what we call the qualifying and the qualifying interest. So the withholding tax on the such incomes is basically what we call the final tax. The third one, you can talk about a person deciding, we can talk about deciding whether to engage in local sale or export. Deciding whether to engage in local or export sales. And we say that we know that export is normally zero. We say zero rated, implying that one will not be charged VAT if he or she decide to engage, if he or she decide to engage in export, that one will basically not be charged VAT if one decide to engage in export. And therefore, if one goes for the export, then definitely is not going to go for VAT. Then we can have number 4, just expounding, making a decision, what do you call a decision in financing, i.e., whether to finance through debt or shares or ordinary share capital, So a taxpayer, you just say a taxpayer should finance through debt, since interest on debt is treated as allowable deduction, because interest on debt is basically treated as allowable deduction. Then you can have the last one, which is 5, claiming, what you call claiming investment allowances. So on this option, a taxpayer, for example, may decide whether to lease or to buy an asset. And if you buy an asset, which is a capital expenditure, you can claim for what you call investment allowance. Just something for learners maybe to expound more on this. Apart from this, you can look at now what you call the tax evasion and how the impact of tax evasion. Why do people evade taxes, and how can one prevent what you call tax evasion? This is tax avoidance, which is legal, but now as a point to maybe push, as a point maybe to understand, one of the areas that are very key in the economy, because a lot of people engages in tax evasion. You need to understand what tax evasion is, what is the effect of tax evasion, and why do people engage in tax evasion, and how do we seal loopholes that are basically in the tax evasion. If we look at that is August examination, the questions that pertains to tax and how one would minimize what we call tax evasion. That is how we basically answer that question 3 Roman B.